Hello, this is Craig Larson with Larson Financial Advisors for the government shutdown version of the Market Minute, October 2nd, 2013. So with the government shutdown about 48 hours old at this point, I thought I would go back and find out what kind of data I could uncover on how the stock markets reacted to previous government shutdowns. Well, I found that since 1970, there's been 17 separate federal government shutdowns, and the most recent one being December 95 to January 96. So it's been a while, but on average, the 1 week after and the 1 month after the shutdown, the stock market had moved less than 1% in either direction. That's average. The worst was about a down minus 6.7% in the 1 month after a shutdown. The best month was a plus 11% after a shutdown. So I think we can look at this and say, statistically, there's not a lot of big movement here with the government shutdowns. So that, I don't think, is a very worrisome point right now. What is worrisome potentially is the debt ceiling. Debt ceiling is a whole different deal than government shutdown, and we don't have good data points on debt ceiling. We've never hit the debt ceiling. The only time we got really close recently was the summer of 2011. And you might remember summer of 2011. As we approached that August debt ceiling, the stock market got very spooked, did a pretty significant cliff jump, went down almost 20% from top to bottom, and was very volatile for a couple of months. So as we look at the debt ceiling now, why does that matter? Well, that's when the government can't borrow anymore. So right now, 40 cents out of every dollar spent by the government is borrowed. So imagine that if we hit the debt ceiling, now the government's got to cut 40% of the spending out. So who are they going to pay? Are they going to pay the bondholders the interest? Are they going to pay the military? Are they going to pay Social Security checks? They're going to have to make some tough decisions. My guess is that if that happened, that would be very disturbing for markets and potentially for the economy. So right now, the Treasury Department says their estimate of when the debt ceiling is hit is October 17th. So we got a couple of weeks. I have seen some other news reports and analysts say that maybe it goes into November, maybe December. But now is the time as an investor, if you're concerned about that potential volatility or that risk, to have a game plan. So hedge your portfolio. That might mean just selling some laggards and raising some cash in the portfolio. Might mean using some inverse ETFs or buying some put options or something. There's a lot of different ways to hedge or take risk off, but now is the time to figure it out, not when we're on the cusp of something significant. So if you have any questions or want some ideas on how to do that, please call or email me. Also, we've just passed into the fourth quarter, so just a friendly reminder that now is the time to get or review any tax moves financially that you want to make between now and the end of the year. Especially if you own a business or real estate investment properties, contact your CPA or tax advisor now and see if there's anything that you should be doing now, because the next 90 days or so are going to go by very quickly, and once January 1st hits, you really can't do much tax-wise to affect your return. So hope that helps, and as always, please call or email with any questions. I'll help out in any way that I can. Thanks for tuning in, and I'll talk to you soon.